All right, welcome to this explainer. Today, we're going to completely demystify leverage for your CFA Level 1 exam. Look, if you're deep into financial statement analysis right now, you already know leverage can feel, honestly, like a total maze of abstract formulas. But we're going to flip that today. We're going to turn those intimidating equations into highly intuitive concepts so you can walk into exam day with absolute confidence.
So let's just dive right in with a pretty provocative question. What if you could literally double your profits without selling a single extra product? I mean, sounds like magic, right? But the answer actually lies in the ultimate double-edged sword of finance: leverage. It's the core engine behind some of the greatest corporate success stories out there, but it's also the main culprit behind some of the most spectacular bankruptcies.
Here's our roadmap for today. We're going to hit what leverage actually is, look at a real-world case with Reliance Jio, break down the core formulas, solve some exam numericals, touch on AI's role in all this, and wrap up with some CFA pro tips. Let's get to it.
Okay, part 1. What exactly is leverage?
Listen, if you remember literally only one thing from this entire explainer, make it this. Leverage is the use of fixed costs to magnify returns. The absolutely crucial point here is that leverage acts as this massive amplifier for a business, and it's driven entirely by fixed costs, not variable ones. When your costs are fixed, every single dollar of revenue you make past your break-even point, that drops straight to the bottom line.
And this brings us to the two distinct flavors you absolutely gotta know for the exam. First, operating leverage. This comes from your day-to-day fixed business costs. You know, things like factory rent, heavy machinery, salaried employees. Financial leverage, on the flip side, comes purely from how you actually fund the business, specifically using debt, which creates those fixed interest payments.
Moving on to Section 2, let's look at a real-world case, Reliance Jio.
It's super fascinating how we can map this exact theory directly onto one of the biggest telecom rollouts in history. Reliance Jio basically poured billions into physical infrastructure, right? Cell towers, fiber optics, massive spectrum. That created incredibly high fixed costs, which means, boom, massive operating leverage. Now, to pay for all that stuff, they utilized a ton of debt funding. So that added a super heavy layer of financial leverage right on top. They really stacked the deck here.
But, the reality of that double-edged sword is pretty stark. Because their costs were heavily fixed, once Jio's subscriber revenue finally scaled up and crossed that magic break-even threshold, their profits absolutely skyrocketed. But we gotta look at the other edge of the blade, right? If that subscriber growth had failed, man, those fixed costs and interest payments wouldn't have cared at all. The losses would have been disastrously magnified.
All right, Section 3. Let's get into the core leverage formulas.
So here are your two primary lenses for the exam. The degree of operating leverage, or DOL, isolates the operations side. It looks at the percentage change in EBIT, your operating income, divided by the percentage change in sales. Then you've got the degree of financial leverage, or DFL. This completely ignores operations and just looks at funding, calculating the percentage change in earnings per share divided by the percentage change in that EBIT. You see how EBIT kind of acts as the bridge between the two formulas? And when you multiply those two together, you get the degree of total leverage, DTL. This shows you the combined magnifying effect of both your operational fixed costs and your debt obligations on your final earnings per share. Honestly, it's the ultimate measure of risk and return volatility for any firm.
Okay, Section 4. Solving exam numericals step by step.
Now, on the actual exam, they're not always just going to hand you the percentages on a silver platter. You'll often have to build it straight from the income statement. Take a look at this sequence. First, we find our contribution margin by subtracting variable costs from sales. So 1,000 minus 600 gives us 400. Step 2, we find EBIT by subtracting fixed costs. 400 minus 200 leaves us with an EBIT of 200. Finally, for the DOL, we just divide that contribution by EBIT. 400 divided by 200 equals exactly 2. See, it's really straightforward arithmetic once you understand the flow.
But here's the essential interpretation, and this is exactly what the CFA graders really want to know you understand. What does that 2 actually mean? Well, it tells us that for this specific company, a tiny 1% increase in sales is going to be amplified into a 2% increase in operating income.
We can do the exact same thing to calculate financial leverage. Say our EBIT is 500 and our interest is 100. Our DFL formula is EBIT divided by EBIT minus interest. So 500 divided by 400 gets us 1.25. And hey, a major warning for you guys here. Remember, you can always run these formulas in reverse. If a question gives you a DOL of 2 and tells you sales jumped 10%, you simply multiply them to realize your EBIT just spiked by 20%. The CFA exam loves to heavily test your ability to work backwards, so watch out for that.
Now, for the full integrated problem, the kind that really separates the passing scores from the failing ones, we just stack our knowledge. You calculate your contribution, find your EBIT, compute your DOL of 2, calculate your DFL of 1.33, and then just multiply them together. 2 times 1.33 gives you a degree of total leverage of 2.66.
And guys, that final 2.66 figure is incredibly powerful. It tells an analyst that just a tiny 1% bump in top-line sales is going to yield a massive 2.66% surge in earnings per share for the shareholders. I mean, that is the pure magic of combined leverage at work.
All right, let's pivot to Section 5, AI's role in modern analysis.
So, obviously for the exam, you're doing this by hand. But in the real world, modern analysts are working way smarter. They're using AI agents like Microsoft Copilot to totally bypass all that manual math we just did. Instead of crunching the numbers for just one company, Copilot instantly calculates leverage ratios across literally thousands of companies. It runs multiple best and worst case stress tests in seconds and automatically flags high-risk entities.
In practice, you literally just upload a company's financials and the AI instantly spits out these critical narrative insights. It'll warn you, for example, high operating leverage detected, earnings highly sensitive to revenue decline. This kind of shift is a total game changer. It allows you, as the analyst, to spend your time focusing on high-level corporate strategy and risk management instead of, getting bogged down in arithmetic.
Okay, final part, Section 6. Let's get you exam ready with some CFA pro tips.
The exam is absolutely going to test both your speed and your foundational logic, so heavily practice those reverse calculations we talked about earlier. Always conceptualize high leverage as high volatility. It inherently equals higher risk. Please don't ignore units or percentages. A simple decimal error will walk you right into a trap answer. And above all else, practice these mixed integrated questions under strict time pressure.
Because ultimately, as this closing quote beautifully captures, leverage is way more than just some equation you have to memorize. It's a fundamental lens to really understand the balance of risk and return in capitalism. If you can master both the numerical mechanics and the strategic intuition behind this lens, you aren't just going to pass level 1. You're going to be a far sharper, much more dangerous financial analyst. So I'll leave you with this. The next time you see a company reporting massive earnings growth, are you going to know how to check if it's actual real operational success or just the dangerous magic of leverage at work? Think about it. Keep studying hard, and we will see you in the next explainer.